people imagine a trader's situation is like mission control, dozens of screens all around. And indeed, some traders do like that. And I think very often they make up for a lack of, particularly if they feel isolated in terms of the trading community, they want to get as many feeds into them as possible. I myself take another view, which is that the danger of too much noise rather than too little is the more problematic. So restricting the amount of data entering the trader's mind is, for me, absolutely central to achieving clarity and simplifying the decision of whether to buy or to sell. I think you can do perfectly well on delayed data, depending slightly on what the sort of trading you're doing. Clearly, if you're trading 5-minute bar charts, a 15-minute delayed data is no good at all. But if you're trading from anything from a day, from one day to the next, or for the next 3 days, then 15 minutes delayed is absolutely fine. Indeed, end of market closing prices is perfectly fine if you're investing for weeks or months. Something we haven't talked about so far, and we need to, is the idea that having understood patterns and trends, a central pillar of my trading activities surrounds the notion of multiple time horizons analysis, which is that we look at any one market from the point of view of the daily chart, the weekly chart, and the monthly chart. And we want to find them, in an ideal situation, we want to find them all aligned, driving the market in the same direction. So we want to have a bullish weekly chart, a bullish monthly chart, and a bullish daily chart. And that gives us all the forces acting on the market at any one time are all pushing in the same direction. And that's a perfect trading situation for me. And in any market, I tend to have a daily chart, a weekly chart, and a monthly chart, and I study them all. And I get excited when they're all either or they're all in a bullish trend, or that if one is reversing, has a completed reversal pattern, then I want to see that the trends in the others are broken, or at least not counteracting. I don't want to see one market with a bull signal and the other market with a bear signal. I want to see them all in accordance with each other. There are dozens and dozens of markets anyone could be looking at. FX, just to go through them, just to sort of set the scene. There's all the FX markets. There are all the bond markets internationally. There are all the equity markets. There are equity indices. There are single stocks. There are commodities. There are money markets. There is an endless array of markets that we could be interested in. How does the trader focus his energies? One danger is that you look at one market. For many years I used to work in the city and in trading rooms, and one man would be trading dollar cable, or would be trading dollar sterling, and he might trade it for 10 years. And that's all he would trade. Typically he wouldn't just be trading it in the sense of looking to buy and sell it, of course. He would be making a market in it. So he would have, as it were, a day-to-day activity to do. Even if he didn't have a view on the market, he'd still be making a buying selling price. But broadly speaking, he would make his bonus and his money by getting his position taking on the dollar sterling right, and he'd just look at one market. Now, from a chartist point of view, there's a problem there, that to wait for really good signals, they might happen quite infrequently. That the notion of the daily, the weekly, and the monthly chart being all in alignment in the dollar sterling might happen once or twice a year. And so you'd be restricted to very few trades. And for all the reasons we've talked about, we know that trading is a percentage game, that charts are not, it's not natural science, it's a social science. So we're looking at forces of putting the probabilities in your favor. So that if you only trade 3 times a year on what look to be well-aligned charts, the chances are that 1.5 of them will not work, or 1 of them, or even 2 of them may not work. So that the chance of making money are quite difficult if you're restricting yourself just to one market, if you're purely trading charts. So that tends to lead the trader to look further afield, to look for more trading opportunities. If you look too far afield, you're looking over too wide a thing, you'll tend not to look seriously enough and in sufficient detail and rigorously enough, because each chart, each market demands 3 or 4 time frames to be analysed before you can reach a trading decision. So you have to find a compromise between focusing too narrowly and having few trading opportunities, or too widely and not being on top of the data that's streaming in. The position is simplified somewhat because in the world as we know it, the very interconnected world as we know it, markets tend to move all together. So when there's a position of tedium in one market, it tends to be tedious in most markets. When there's an exciting situation, it tends to transmit itself to other markets. So what that means is that you can look at quite a lot of markets, but they tend to move at least in related form together. So when you look at more than one market, the idea is to look at the best one to trade, as opposed to the one that's, you'll very rarely find there's a wonderful trade here and there are no other trades elsewhere. Typically there's a wonderful trade here and there are stronger or weaker versions of that trade in lots of other markets. So the position is not quite as simple as it seems in terms of too much information, but you still need to compare and contrast as to which is the best market to register that move in. I think it's very important to restrict the amount of information that you try and take in and become master of the markets you are. So I would tend to choose markets that don't necessarily move together because that's just duplicating your effort. I tend to choose a bond market, FX markets, have a good range of different sorts of markets, but not too many, so that there's an opportunity for markets to be shall we say, not moving together, not duplicating trades. It's a percentage game, and all we're doing, we must always remind ourselves, is putting the percentages in our favour, not hitting cast iron opportunities. So that requires us to keep doing that because over time, then we'll be making money over time, not on any one trade, but on the average of all our trades. If we keep trading and analysing the charts correctly, and we keep trading on the same slightly improved percentages, then we'll make money over time, over many trades. In terms of frequency of trading, there's this simple distinction between a trader and an investor. Traders will tend to trade more frequently than investors, but that's the only difference between them in my book. Traders can, you need to suit your, you need to find what works for the individual. Basically, the trader needs to find what works for himself. And if you're just looking at the markets once a day, then you have to restrict yourself to trading over weeks and months rather than the next 2 days. If you look at the market 10 times a day, then you can trade both intraday and from one day to the next.